SPAC deals have attracted big-name entrepreneurs, hedge fund managers, and celebrities such as Richard Branson, Bill Ackerman, and Michael Jordan, as well as mutual fund businesses like Fidelity and T. Rowe Price, and investment banks like Morgan Stanley, Credit Suisse, and Goldman Sachs. Over the last period, these SPAC deals have grown in popularity. But what is an SPAC deal? Why are they booming so much? And what is the risk of investing in them? Welcome back to New Vehicle Media, your go-to channel for EV stocks. Quick reminder that subscribing's free and liking helps YouTube suggest similar videos to you. Comments are simply loved and will be featured in upcoming videos. What is an SPAC? SPAC stands for Special Purpose Acquisition Company, which is a publicly traded company with no operations and no assets. They have a large cash reserve and only one stated business strategy: to buy another company in the future. An SPAC is often founded by a group of investors, a management team known as sponsors, who have extensive experience and knowledge in a specific industry or business sector. For them, it has become the preferred method of taking companies public. They buy a privately held company by raising capital from other investors. The private firm is then subsequently taken public. For this, an SPAC issues an initial public offering, IPO, to raise the funds needed to complete a private firm acquisition. The cash comes from both regular and institutional investors, and the money raised in the IPO is held in a trust account 100% of the time. Investors receive units in exchange for their money, with each unit consisting of a share of common stock and a warrant to buy more shares at a later date. The SPAC will normally need to seek shareholder approval for a merger and will prepare and file a proxy statement after it has been established. The transaction will close once shareholders approve the merger and all regulatory issues have been resolved, and the target business will become a public corporation. The SPAC sponsors usually don't have a specific target in mind when they launch it, or they aren't ready to declare it yet in order to avoid the SEC extensive paperwork and disclosures. Early bird underwriters and institutional investors, alongside with private investors who join in the SPAC deal, have little understanding about how the sponsors will spend their money. So in the hopes of grabbing a successful investment, the investors rely on the management's reputation. The acquisition firm is required to place investor funds in a trust or escrow account until the target company is publicly announced. If investors don't like the deal at that point, they should be able to get their money back. IPO versus SPACs. Special purpose acquisition companies are the preferred way of going public in the modern era, as evidenced from the facts that there were 242 SPAC deals in 2020, 4 times the number in 2019. If you think that's a big number, wait till the end of this year. As of July 2021, 359 SPAC deals have been filed, and many more to come later this year. In a traditional IPO, a new company starts and develops a business. That firm may eventually reach a size where it believes it has the resources and structures in place to handle the IPO process, as well as the associated SEC reporting obligations, and decides to seek financing in the public markets, thereby becoming a public company. However, there is a problem with the traditional IPO. It's very hectic. In a traditional IPO, you try to get investors to invest, and your valuation are not certain until you reach the offering date. You're also dealing with a number of investors, most of whom are institutional, which is time-consuming and inconvenient. Uncertainty can also sabotage an IPO. Remember WeWork? With an IPO, the corporation hoped to raise almost $4 billion. Instead, the IPO was canceled after people presented dramatic readings of its S1 as comic routines. On the other hand, SPAC has advantages over the traditional IPO. An SPAC merger typically takes 3 to 6 months to complete, whereas an IPO often takes 12 to 18 months. They're inexpensive. Most of the SPACs are priced at $10 per share, making them easily accessible to regular investors. They're usually not very volatile during the first few days of the arrangements. They put their money into hot areas. SPACs focus on the most appealing sectors in the digital and consumer industries. They have helped promising startups such as Opendoor, Clover Health, and electric manufacturer Nikola and Lucid Motors go public. Individual investors are welcome to participate here, despite the fact that institutional investors normally receive first hands on SPAC offerings. The large number of shares offered makes it easier for smaller investors to participate. With its advantages, SPAC also comes with its threats, risks. Often recognized as blind investment, investors of special acquisition firms typically have no idea how their money will be spent or who the SPAC's target firm is, and often, at times, neither the sponsors have the information of the target firm. As a result, evaluating the offer is impossible. Also, there is a big lag time. The delay between when investors put money into an SPAC and when it actually buys a firm and starts operations can be long. An escrow account can hold your funds for up to 2 years. Your cash will be repaid if no acquisition occurs, but idle capital for that long can be painful. As the first rule of finance, which is time value of money, meaning money loses its value over time if kept idle. SPAC deals were not always smooth and had a very shaky track record. Back in the 1980s, SPAC deals were used to be exploited. There was a lot of fraud around these blank check organizations. Many of them were nothing more than shell firms, selling lightly traded penny stocks or pink sheets. Frequently, these firms either stole money from investors or engaged in inflated insider dealings, leaving many investors with nothing. Risk can also be associated in a form where the SPAC owners are tapping into the market in a very innovative way they believe they can get profit. Recent example of Bill Ackman's PSTH firm, where they made a new type of acquisition, SPAC, a special purpose acquisition rights company. The mergers didn't make it and ended up as a failed merger. The conclusion: SPACs can be a method for ordinary retail investors to participate in a private firm before it goes public by investing in a public company that will target that startup for you. Is it possible that there are currently too many SPACs? Yes, of course. Is there a surplus of SPACs targeting the same industries? Undoubtedly, once again. This means that a significant number of these blank check companies will either return their money to investors or become involved in overcrowded areas that were simply popular at the time. What do you think about the future of SPAC deals? Do they think they need innovators like Bill Ackman's? Let me know in the comment section. I'm always stoked to hear your answers. Kike85 believes that Lucid Motors will be rocketed into space. A very pensive reference with that emoji. What do you think? Do you agree that Lucid will make it to space? Leave your thoughts in the comments below. And that should wrap things up for today. Remember, subscribing, it's still free, and liking helps YouTube to understand your preferences. Thanks for watching.